Hello, everyone. Hello. I am back, and we're doing section 7 on multifamily acquisitions and all the things you need to know. Now, this part, we're going to be talking about the debt. And essentially, what we're doing is the next couple of conversations, we'll be talking about building your capital stack. And, it just amazes me how many people are afraid of that term. Like they're nervous about it. They don't like, oh, geez, what's my capital stack? I don't have a capital stack. What am I going to do? Capital stack is nothing more than the sourcing of 100% of the money it takes to buy that property. And when I mean sourcing, let's just break it down when you bought a house. What was your capital stack then? It was the bank and your down payment. Congratulations. That's your capital stack. Same thing is true with multifamily. It's just a fancy way for figuring out all the slices. Now, the thing about multifamily or larger acquisitions is that sometimes these acquisitions are, and I'm going to let that ring one more time before I go it up there. And all right. Sometimes these acquisitions are pretty complicated, and you can't just show up with your down payment. You need to raise that additional capital in different forms. And so they all starts to layer on top until you get to 100%, and that's your capital stack. So, that's a very important thing to understand when you're trying to pitch to investors, because the investors are always going to want to know where they sit on the capital stack. The lower on the capital stack, the safer the money is for that investor. That's why banks' money is at the bottom. Well, you don't pay, they foreclose, they take everything, and everybody above them loses everything. But then on top of that bank debt, there may be mezzanine debt. It's sort of more expensive debt than the bank debt, but it has the same or similar obligations to it. So in that regard, that's how you stack up where all the money goes. You add it all together, and it is your capital stack. So let's talk for a moment about the different types of loans, and then the terms of the loans, and then understanding the debt coverage ratio. I'm going to run through all of these things. So the first thing is, where do you source your debt? And debt typically is a bank or a private lender. But anybody that has a foreclosure right on the property, or some type of interest or a term to the loan. So that's what I'm talking about when I talk about debt. Now, when you're looking at multifamily, you can look at a conventional bank. I call it Frank's Bank. You can look at agency loans like Fannie Mae or Freddie Mac, FHA loans. And then you have other things called CMBS loans, which are commercial mortgage-backed securities, which are not technically debt. It's a security, but it looks, acts, and feels like debt. A lot of similarities to those. And all of those things have pros and cons. Let me just give you the most basic pro and con regarding Frank's Bank and the government-sponsored entities. Government-sponsored entities, Fannie and Freddie, they'll give you terms. They'll give you one thing that's called non-recourse loans. And that's nice, because if the deal fails, you can drop the keys on the bank's desk and walk away, and they can't touch your home. But Frank's Bank, the more local conventional, those guys are going to tie you up. They are very risk averse. They want to be safe. So they go in there and they hold you tight, and they say, you're going to have to pay us back. And if your property fails, we can come after your house. That's called personal recourse. All right. And then the thing about, if it fails, a commercial mortgage-backed security, because it's not a bank loan, there's nothing for them to negotiate. You go in there and you say, hey, listen, I'm not doing well. I'm going to miss the maturity date. I just need more time. Can we work something out? The CMBS lender is going to say, no, that's not how we work. We'll just take the property back. Well, no, come on, give me another chance. Nope, we're just going to take the property back. Whereas Frank will sit down with you in a roadside diner, sharing French fries with ketchup all over the plate, and negotiate a revision to the terms of his note. And if that sounds like it happened to me, you're absolutely right. It happened to me. So these are the things you need to understand when you're looking at these different types of loans. Who does what? All right. Now, the next question you're going to get is, what are the loan terms and the amortization? So, loan terms um, are the term of the loan. All right. Yeah. Well, it sounds simple, but it's so different because a lot of times people are coming from single family housing scenarios into multifamily. So they come to the table with that mindset. And that mindset you need to leave back with the single family side. Here's why. Let's talk amortization. On a single family home, it's typically 30-year amortization. On a multifamily, it depends a lot on the lender and the type of risk. If it's a Class A property, you're going to see a 30-year loan with some of these lenders. If it's a Fannie Mae or Freddie Mac, you're going to see 30-year AMs with these lenders. If it's a Frank's Bank, you're going to see 20, 25-year amortization because they are very risk averse. They want to get their money back. They want you to pay down that mortgage quickly. And that's why you see shorter amortizations on a local lender than you do on a Fannie Mae or a Freddie Mac. That just means that the debt is more expensive. And so therefore, because it's more expensive, it's going to be harder to make the numbers work. And then your investors will get a shorter cash on cash return. It'll look good in the long term, but in the short term, your investors aren't going to think, wow, why am I not getting these great returns? It's because the debt's so expensive. So that's the amortization. Now let's talk about the term. For those people coming from the single family side, they don't know what I'm talking about. What do you mean term and amortization? They're both the same thing. It's a 30-year term and it's a 30-year amortization. Yeah, but on the multifamily side, this is real true commercial paper and you don't get those types of terms. And so here's how it works. When you walk in the bank, you get a 5, 7, 10-year term. So you never pay it off in 30 years. You got to pay this thing back in 5 years, 7 years, 10 years. And this is where it really gets important to understand this term, especially in light of what has just gone on in the multifamily world, where the interest rates started going up. It became so much more expensive to get debt. And therefore, when the values of the properties came down because you couldn't buy as much property. You couldn't afford more cheap money, bank money. So what happened was these banks or these investors who got the 5-year or the 7-year, the shorter term terms, all of a sudden the note becomes due and payable, and the market's turned. And they've got 5 years and they're up in the 5th year, and it's called maturity defaults. And that's what we're seeing now with a lot of problems with these multifamily loans is the debts are maturing and the value has come down and you can't refinance out. You can't sell it. You end up losing all your equity. And that's the risk that people take. So what happens is, if you're looking to protect yourself from something like that happening, number one thing is you've got to have an amortizing debt, 30, 25, 20. Faster you pay down that note, the better off you're going to be, but it's going to hurt your returns. All right. So that's one thing. The second thing is the longer term that you have is better for you. It gives you more opportunities and longer periods of opportunity to sell your property and get out before the getting's good. We'll talk about prepayment penalties in just a moment. So these are the things you need to think about. It's so interesting to see some of these guys who were flying high back during the mid 2015s, and they were just buying property and they could not do anything wrong. And all of a sudden the market changed and they're screwed. And then I remember interviewing a guy on my podcast. I think his name is Brian Burke, great guy. And I just love listening to him because all he talked about was how safe and secure the financing that he did with his banks, and how he doesn't have to worry about any of these economic changes because he built his business on sound foundation as opposed to a bunch of matchsticks like some of these people. All right. Then after the loan amortization and the loan terms and the amortization, we've got to take into consideration the debt coverage ratio. Now, folks, I'm going to explain to you the debt coverage ratio in a way that has never been explained to you before, and you're going to get it. And this is what's going to make you understand exactly the whole concept behind it. The debt coverage ratio is a ratio that the bank uses to figure out whether you're going to be able to make the mortgage payments or not. And so what you have to look at are two numbers. The net operating income, you all know what that is. If you're doing multifamily, you know what the net operating income is, and then the mortgage amount. And of course, we're matching these over the same period of time. So if you take your annual NOI, you have to put it over the annual debt coverage, like what 12 months of mortgage payments. That gives you your debt coverage ratio, and the banks typically want 1.2 to be the debt coverage ratio. Now, let me explain to you what that number represents so that you understand it. You can, every time you look at it again from now on, you will get it. So here's how it works. The debt coverage ratio is the NOI over the mortgage payment and reported in a ratio. Banks minimum tend to be 1.2, 1.25. That means that for every $1.20 that property makes in net operating income, $1 goes to the bank and 20 cents comes to you. If your debt coverage ratio is 1.55, that means for every $1.55 that your NOI makes, the bank gets the first dollar, you get 55 cents. So when you think about it that way, you will always understand why you want to get that higher number. I call the debt coverage ratio your sleep number. The higher the number, the better off you're going to be to sleep. You're going to sleep a lot easier. All right. And I also say that the debt coverage ratio is a dynamic number. It's not static. What I mean by that is the banks will say, well, all you have to get is a 1.2 debt coverage ratio, and we'll sell you our money. Well, you shouldn't buy it, because at $1.20, it could be very, very risky. And the debt coverage ratio does not sit well with all properties. If you've got a solid Class A property with Class A tenants, you can get away with a 1.3 debt coverage ratio and you'll do fine. If you've got a C-class property that's been fighting to keep 80% occupancy, you've got to think twice about a 1.5 debt coverage ratio. You want to get something a lot higher, just because it's how good are your tenants at paying you? C-class properties, they aren't all that great. They don't care about their credit rating. They'll skip on you in the middle of the night. Class A property, those tenants are a lot better. They pay their bills. They stay on top of things. So that's how you want to think about the debt coverage ratio, and when you're putting together your terms here. All right. The other thing we're going to talk about are the interest rate and the different types of interest rate options. Now, the first thing that we're going to talk about are the fixed versus floating. All right. So I'll tell you, after what I've seen in the last 2 to 3 years, I would never do floating rates. That's what killed so many of these, because they had to buy a protection that if the interest rate went above so much, they had to activate that protection, that insurance policy. And the banks required those policies, and they got very expensive. And sometimes the people couldn't afford it anymore. And so they ended up losing the property. If they had a fixed rate interest rate, they never would have had a problem. And now, if you're looking to go buy a property and you're looking to raise private money with other people, get a fixed rate mortgage, and they'll be very comfortable with doing business with you. All right. So keep that in mind. Um, Let me see what is next in my bag of tricks. Oh, you got to talk about prepayment penalties. All right. Now, some you have to there's terminology that I want you to understand. If you're dealing with a local lender like a Frank's Bank, you can say prepayment penalty, and everybody knows what you're talking about. 5, 4, 3, 2, 2, 1, 1, 1, 1, 7, 5, 4, 3. You want to get as little a prepayment penalty as possible. All of that is negotiable with Frank. Frank will negotiate with you what the terms are. Now, when we're talking about the Fannie and the Freddies and the CMBSs, you can't talk prepayment penalty. You talk about yield maintenance. Yield maintenance is one of the types of prepayment penalties that exist with CMBS notes. Now, let me explain to you how yield maintenance works, or yield maintenance, or what's called defeasance. Now, I'm going to type in a website. I may get this wrong. I may have that wrong, but there's a website called Defease with Ease. And this is a way to figure out what the prepayment penalty is going to be on a property that has a debt that has defeasance or yield maintenance. Now, let me explain to you how this works, so you'll understand how tough it is to figure out exactly how much is owed on that property in the event of a prepayment of the loan. But you can plug the numbers into a website like this, and they will tell you exactly. So here's how it works. When you go out there and you use a commercial mortgage-backed security to buy that property, you're not really getting a mortgage. It's really a security. You're funding a security. So what happens is grandma goes and she's got $100,000 CD that's maturing, and she wants to just roll it over into the next deal, and she just wants it to take care of itself. So she goes down to Bank of America and speaks to her Merrill Lynch rep there, and he says, "I've got these great things called commercial mortgage-backed securities. You're investing in a multifamily property, very high quality property, and they have to pay you back this type of return. And if they don't, well, then there are special servicers and general servicers who step in and manage that asset until everyone gets paid." So what's happening is grandma puts her money in there, and she puts it in for a certain period of time, 7 years. And if the property that is paying grandma for the next 7 years decides that they don't want to do it anymore, they want to sell the property and get out of that loan, well, the guys that lent you that money promised grandma a certain amount of money that would be coming in every single month. And so if they're not going to get it from you every single month as you own that property, they're going to take it from you at the closing table, set it in a bank so they've got it set aside to pay grandma. And that's the yield maintenance. They have to maintain a certain yield of return to grandma. And so it's not a prepayment penalty, it's a yield maintenance penalty. And that means that they're just taking all of grandma's payments from you when you sell before the end of the term, so that they will have money in the bank to continue to pay grandma. All right. So that's how the yield maintenance works. And that's part of the problem with these things is, that's why you always hear an assumption. Well, if it's an assumption, you can almost, bet your bottom dollar that it is a commercial mortgage-backed security instrument. And now you're going to you're going to be the assumptor versus the assumptee. You're going to be taking over that mortgage so that guy doesn't have to pay those, they don't have to pay those defeasance or yield maintenance penalties. Now it's going to be your problem. So as you can see, I always see these assumptions differently. If you're buying a property and assuming the existing mortgage, that you're doing that seller a huge favor because you're taking on his bad negotiations. And chances are very good that you're going to have to take that loan right to the very end because you're not going to find somebody else to assume it with only a year or 2 years left in the loan. So you're doing the seller a big favor. There should be some quid pro quo, and it's not always that way. So that's how yield maintenance, defeasance, prepayment penalty, these are all things you need to understand when you're negotiating a loan, and understand, because if your investment strategy is a short-term hold with your investors, you can't do a Fannie or Freddie. So don't even bring it up, because those prepayment penalties are going to be huge, and you've got to find somebody to assume it. And if you can't, then your returns are going to look terrible. So just don't be that guy. All right. And don't assume that all the terms are non-negotiable. You've got to leverage your relationships and really shop around for better terms and interest rates. But here's the thing, and this is the most important thing about these commercial loans. And this is the problem that many residential people have. Residential people will go out to 30 different mortgage companies and see who comes back with the best ones. And that's just the way it works. On multifamily, it's commercial. You don't do it that way, because behind the wall is Fannie and Freddie. You got 20 people out there, 20 different companies called DUS lenders, delegated underwriters and servicers. You got 20 of those out there. They're all wanting your business. They're all saying, hey, come with me, come with me. Hey, I can show you the best things. I can do all these great things. You sign up with 3 of them. You give them the applications and you got to pay a fee. And they all send them back to Fannie and Freddie. And Fannie sees this thing coming in from 3 different sources. Like, what are these guys doing? Don't they know how this game is played? You pick one commercial broker and you stick with them. That's how it works on the commercial side. Okay. So that is something else you need to understand. Don't find someone that you can do business with. I've got a couple of guys that I know, like, and trust. Been working with them for years. They are fantastic. I'm gonna put their names in here. Let me just put that one here. All right, this is my old buddy, Bob Damigella. He's with Marcus and Millichap Financial. And then another good old boy, always a good guy to go to in a pinch. And then we got good old Kevin Jenkins, Northmark Capital. Kevin I think he's down in South Carolina. Bob is in Boston. If you need their numbers, just shoot me a private message and I'll get it over to you. Well, let me just come over here and make sure I'm okay. So now the final thing, and this is key, and this is where a lot of people get scared away. You have to understand how these guys underwrite their deals. And, it's, if this is your first time doing a multifamily deal, well, you might have a little trouble getting approved, but that's okay. What you have to do is work with a broker that knows how to get you approved. And it might mean you having to partner with an investor who's got a little bit more savvy, a little bit more experience, a little more gravitas, as Al Gore used to say, a little more gravitas to discuss how they're going to get you across the finish line. You might need a partner. So what you're looking for is what the banks call a KP, a key principal. Now, typically the requirements of a KP is they've got a balance sheet that equals the value of the property. They've got liquidity that equals 1 year's worth of capital, your mortgage payments. And they've got a resume where they've done this before. So those are essentially the three things that the banks are looking for in a KP. If you don't have that, well, then you're going to have to sign somebody else up. But that's okay. That's just the way this business works. It's not like a bad thing. You put together your team, and that's what we do in Louisville. That's what we do in any other deal. So just keep that in mind when you're going through the process. Not only are you looking for private money or equity to bring to the table, you're also looking for a KP. I mean, some of my students, I set them up with other students who would qualify as a KP, and they end up crossing the finish line that way. Listen, folks, this is just doing what you have to do to get to the closing table, step by step by step by step. So keep that in mind, and that's how we, obviously, if we're representing you through the closing process, we're going to make sure that you're getting all your T's crossed and your I's dotted. And we're going to do everything we can to help you with that. And oh yeah, I spelled Kevin's name correctly right there, Kevin Jenkins. Oh, Northmark. I knew there was something wrong in there. Northmark Capital. Yeah, there we go. There we go. Northmark Capital, Kevin Jenkins. Marcus and Millichap. I got that one right? Bob DeMagello, Marcus and Millichap Financial. Two of my good friends. Highly recommend either one of those guys. They are Bob is out there teaching people about multifamily finance as well. He and I are going to collaborate on some stuff. He's going to help me with my program, and I'm going to help him with his program. But I recommend all of these guys. Good peeps. But that's it, folks. This is a discussion that I want to make you understand all the things that are going to come up. Part of what we do is we help you with the loan documents. You've heard me say it before. You are the lead on the acquisition. You have to be the quarterback of the deal. You would better understand all the terms in the purchase and sale contract, and you would better understand what the terms are in your loan documents, because the last thing you want to do is ever be in breach of any of your loan covenants. And if that happens, your property can be put into a default. And if that's the case, they can use a default interest rate, and you go from your 5% interest to 12% interest overnight. So make sure when you're quarterbacking these deals, you know exactly what it takes in order to satisfy the loan and make everything work. So that is it for today. And I will be seeing some of you at 4:00 when I do my hotels to homes cohort call. And otherwise, I want everybody to have a great weekend. It was an amazing week. What this country has just gone through. I'm glad it's done. I think everybody's glad it's over with. But that's I've already seen so many investors out there saying this is going to be great. I've already seen such a buzz already in less than a week with what's happening in the real estate industry, and things are it's like the pop has been decorked, and the cork has been popped. That's what I meant to say. And we're going to see things moving again. Thanks, everybody. Great to see you all, and we'll chat later.